This is the video you guys have all been waiting for. It is my long-term analysis for the stock market. This is going to be all the way throughout the next year. So end of 2022 all the way into 2023 to about fall of 2023. I'm going to give you this as a guide or indicator of what can happen. Obviously, this may not be the case. However, as you've seen through the past videos, I do have a pretty decent head of my shoulders on where the market can go, especially during an intraday 1 to 3 week time frame. So I'm going to be applying some of the same principles just for a longer term view in this video. I know you guys are going to like this one. Here's an outline of what I'm going to be talking about. All of each section is in the description below if you want to skip to each part. However, you guys are all going to want to watch each part through it because I put a lot of time into this, and I do believe this will be very beneficial to any trader, whether you're intraday all the way until long-term investors. First, we're going to talk about technicals. You guys know, if you've been watching the videos, I'm very experienced in terms of technical analysis, and that is my main go-to form of risk mitigation, as well as kind of getting a sense on where we can go in the future off of support and resistances. I use this along with many other variables, including cheddar flow data, to get a sense on where we can go, whether that be the market or just individual tickers. Now, something very important here that happened that I have not shared with anybody yet. This line that I've talked about in previous videos, the one that goes from 2009 lows, it actually goes across and acts as a resistance for many years. It started the 2018 correction, the same line, and also the 2020 crash. This is the level that we fell off of before falling quite a bit. Only until 2020 did this line get broken to the upside with a monthly close. This close right here that you can see was incredibly crucial because we closed above it convincingly on the monthly and continued higher after that, and that's when we started to rip for the skies, just continuous months after months. A lot of people have also claimed there might be a melt up on the way. I've seen on Twitter. Could there be? By all means, yes. However, I believe this phase that we had right here after getting above this line was the form of a melt up, and actually was before a lot of people may have thought that melt up may have happened. This was all during QE, where we had a lot of liquidity go in the market, and now we're starting to see the after effects of all that liquidity being pumped in. What's very important is this is the first month that we closed below this orange line since the time that we broke above it. So this monthly candle for June is very bearish on a macro standpoint because we are now under this line. Unless we have another monthly close above this orange line in the future, this thing will continue down and will start to accelerate selling downward because we had a big fake out to the upside of this major pattern. Now, this is not something that just is going to happen within today or tomorrow or anything like that. I actually believe we'll have a complete retest of this level if we go to a shorter time frame here. By the way, these lines I have on here are dark pool prints. I like to get a sense on where big money is accumulating or distributing shares on the dark pools, and we do have this feature on Cheddar Flow on the 4th tab here, and I just have them marked on here because they're sizable prints to get that away from confusion for you guys. But I do believe we actually will have a bounce to retest this level and actually might be able to go above this level. So as of now, we had a perfect retest here on June 28th. It had a perfect retest, and there was a large fake out, this is how I was able to determine there might be a fake out during that day, which I shared in the chat. It was directly off of this line, as well as another model that I use. And that's why I was able to determine we might have a big fake out there. Now, I still believe we might be able to get over this level and have at least some more upside to over this level. However, I don't believe the monthly candle will close above, which is crucial. And that is the first thing we need to note, is that we now are below this orange line, which means that sell pressure is going to be even more. This is above the line here was the major bull run. This was very, very bullish when we were above it. And now we have rejected that and gone back under, which is the first crucial thing you need to note. Secondly, I want to look at the large cap charts. These are actually very, very bearish at a macro sense. I do believe actually we will get a bounce short term. So around the time that I'm publishing this video for July, remember, I am relatively bullish for July. Today is actually FOMC minutes, so there is going to be a lot of volatility. We may even close down, but when you're watching this after FOMC minutes or in the future on what's the July 6th, it could close down and maybe continue down for a few days or go up after. I still am bullish for this month of July, no matter how the daily closes today. Just putting that out there. So Microsoft here. we have a head and shoulders on as well, and this is a large head and shoulders, especially because it kind of went parabolic since the early 2010 2012 time period. It had consolidated for a very long time and then broke out and just went parabolic off of that, especially when the market was going up quite a bit. But now we have a topping process kind of taking place. We have a head and shoulders over here, and unless this level of 315 is taken out over here, and I'll mark it for you guys, unless this level is taken out within this next year, then all-time highs are off the table for Microsoft for a bit, and that may be 2 or 3 years, or up to 2 and 3 years. And the reason I say that is because this head and shoulders pattern is a very, very bearish pattern, especially after having such a large move. And now we are under this key demand zone that was held many, many times on this weekly chart. And getting below this is very bearish. That's not a good thing for this ticker, the fact that we're now below this. And if it wanted to get at least a little bit more in terms of intermediate upside, it would need to get back above this on the weekly. However, I still believe we have a lot more downside on this. Probably goes down to under 220, consolidates in this range because of what we had over here. So that's just what I'm looking at for Microsoft right now. Apple, next one that I'm talking about. This one had a kind of like a rising channel that we were trading within for a long time. Back in 2020 it started, and it was trading within. You could see the bottom of the blue line was support, top was resistance, and we actually broke out above here but was not able to hold. This acted as a very large supply zone, which I can show you here with this box. This was a very large supply zone, and a lot of people, especially big money, was getting out during this time period. We saw a lot of large dark pool prints around this period up here. And then the big downhill kind of like cascade started, and it was not able to hold this blue line on the weekly during this week, so continued down, retested it, and now is still below. Do I believe we may have another retest in the future? Yes, I actually do believe that may happen. It still is a bit higher. It would be like around 152. If it happens or not, I still have a bearish emphasis, especially for the fall months going forward on Apple. And everyone knows if Apple has weakness, then the market is also going to be weak along with it. So next up, I'm going to check the flow. What I really, really like about Cheddar Flow is they have the historical flow tab right here. You can check any type of flow on any individual ticker whenever you want based on history. So I went back to May 1st here. I clicked on it and then also went to today, which is July 6th, and I can see the range in between the last 2 months on what flow we got. Also, I filtered for above 5 million in premium, and this is what we got. We have a 97% put flow to 3% call flow. And not only is it just put flow, it is also aggressively bearish, and there are just pages full of this flow. Like scrolling down through this, it is ridiculous how much bearishness we're seeing and how much put flow just with barely any calls. And most of these, like this one, means nothing. It's just a super deep in the money hedge that this person had. So just this is excessively bearish, and it's very similar along with QQQ and as well as other ETFs and large names. And just scrolling through this, just very, very bearish. That is the first thing to look at. Now, obviously some of these were trades and they have been closed. However, it's been a common theme that we're seeing a lot of puts being bought, especially within the next month to 2 month expirations, which brings me to my next point here. We're seeing a lot of heavy put flow in not only August, so the 8/19 expiration, but also we're seeing some September ones as well, which would be that 9/16. So what's very interesting about that time period is seasonally, that is a very, very weak period, and one of the weakest periods of the year besides March in the market, which means there could be potential downside during the September to October months, which is kind of matching my thesis as of now, where we could see some form of upside to above this orange line like I shared with you guys earlier, but then a rejection to just below maybe by end of July, maybe some more upside into August as well to kind of fake people out, have 2 months that we go above here but don't close specifically above, which is a key thing. And then during the fall, we actually begin to fall and a lot more. We're seeing a lot of these puts come in for this expiration, and I want you guys to continue to look at these puts as we get nearer and nearer to the fall. I expect to see a lot of September ones that they'll roll these 8/19s to September as well as October once we hit that period. Again, like I said, seasonally, that is a very, very weak time period, and also was kind of around that period where in the past we've seen many, many corrections. So having a correction when we already, or at least having weakness in terms of seasonality while we're already weak to begin with, is not a good recipe. So you do need to be careful and also watch that put flow as we go forward here. Another important thing to do is to look at past large corrections and bear markets. This is a very key thing to do just to get a basis on what potentially could happen. Again, history does not have to repeat itself, but to get a sense on kind of how SPY and other various tickers as well as the markets traded during these very, very weak periods of time. So what I'm going to do here is I'm going to mark out where we made this first high, or meaningful high, which was on July 9th. Now, if we go to where the low occurred over here, which was the 9th of March, you can see here, this is a very large time period that we had that was in between both of these times, almost 2 years full. So just by a few months, it was short. So almost 2 years, the market was definitely in a bear market. Obviously, it takes 20% down to actually hit that bear market, but from highs, which happened around here, obviously we still went a bit above during this week, but for the most part, this is when this large corrective phase happened. It was about 2 years that we had to wait until this meaningful bottom happened, and then it rallied off of that. So that is another interesting aspect here, because a lot of people may think where we are right now, if we go up, as you can see, you have to go scroll through a ton to get up to where we are. Just crazy how parabolic it's went since then. But where we are right now, if you draw this line from the top, which I could even say it was back here, you could say the high was the top, but we started this corrective phase, and people started distribution around this level. You can say it started around November 1st of 2021 within this range. So it hasn't even been a year yet, which is another interesting thing, like I said. So if it's similar to what we saw in the dot-com bubble, which was also around 2 to 3 years for it to bottom, and also around this 2007 to 2009 range, it would be about 2 years for us to actually reach a meaningful bottom, which means we're not even a year into this correction yet. That's a very important concept to realize. Again, it goes with the fact that I don't believe we'll see all-time highs anytime soon, until three or so years, honestly, until it could bounce back to that level. But especially because everything went parabolic around this time, and we're starting to see the repercussions of all this policy that we had during COVID and before. This is a very dire situation that we're in right now, and you do need to be careful with this macro setup, because knowing that this could take 2 years to bottom, you need to be careful. A lot of people are adding the dips on like growth stocks and stuff. Like, look at stuff like Shop. Just for example here, this thing has gotten hammered. A chart like this doesn't just V-bounce up and go straight back up. It will take a lot of time to consolidate before it even has a chance at going up to this high. Maybe you're willing to wait. That could be a viable scenario. If you have a lot of time on your hands, that could be a good idea, but I'm not going to buy this for a dip. Even if you believe in the future this thing will go back to the valuations that it was close to during 2020, it's going to take so long to consolidate. It could be another year just within this 80 to 20 range, which is still a wide range that you can trade within. But in terms of a long term, this thing is not going anywhere because of how much downward force it has right now. And it's very similar with all these growth stocks, and will be similar with a lot of large caps as well. It'll take time to be able to consolidate, and will be very choppy before it gets back up again, which is crucial to note, because a lot of people are putting their retirement funds and a lot of long-term funds right now, when it could be up to 2 years until we actually bottom, based on what I was sharing with you before. Now, a lot of people are scared to a sense right now how the market is, but I don't believe it's enough yet. And another reason why I think that is because if you look here at the VIX, this has been suppressed for a very long time right now. Because the market's been falling down quite a bit, you'd expect the VIX to have some pops. Not quite as big as COVID, because we had a big crash during that time period, but at least during like the corrective phases of 2018 that we saw it go all the way up to 50. We haven't even cracked the 35 level meaningfully. We haven't had a close above the 35 level yet, which is a key level, by the way, for us to get above in the future, and you will want to watch that. If we do get a weekly close above, that probably means more downside in the market. But again, we haven't had a close above this level yet, and we've fallen so much since then. Over $100 on SPY, 120 to be precise on SPY. So this shows me we haven't had enough fear yet in the market, and until we get above to like 45 or 50 levels, kind of similar to this 2018 correction, I don't believe there's going to be a meaningful low that can last for around 4 to 6 months at least. So I'm waiting on the VIX to kind of make a pop, and it is kind of inching up so far, starting to curl a bit right now, which is a key thing to note. But for now, we haven't reached that big low that will give us a lot of months to be able to go long off of. Another concept I want to cover is various other markets, including the bond market, the dollar, as well as commodity markets. So right now, the dollar broke out and had a very decisive breakout, as you can see here on the monthly. A key break was this 103.5 level, which we had a monthly close over, and now it's starting to rip way higher from where we are right now. The key to getting this large breakout, though, was this big trend line break that we had right here on the monthly, even before the 103.5 level was broken. This was very large and was able to kind of set it up for even more of a push afterwards. In terms of the overall analysis, this is a very large break, and we could see it continue higher and higher from here, which is definitely not ideal for the market when the dollar is ripping like it is right now. Another thing to note is the bond market, like I said. So the bond market is looking a bit, it's at least starting to price in a lot of fear going forward, as you can see from this chart right here. This chart, the white at least on it, is the bond market kind of like options fear index, and the orange below is the normal VIX for the market right now. As you can see, there's a very large discrepancy in both, and we're going to find out soon who's right. And typically the bond market does price in things well before the options market in the US stock exchange does. So that's another thing to note right there. Lastly, commodities. We saw a major downside move in commodities from this week, and I'll go to the weekly chart here for this because this is a relatively new concept that's starting to emerge. Remember, we saw a lot of increase and inflate of these commodity prices lately, and then until now we're starting to see some downside on these. So you can see with oil here, some very large downside on this week, and it does look like it made relatively close to a double top. You can see the first top over here and the second over here with these wicks. Another thing to note right here with a double top is gold. So this was making a major cup and handle, a 11-year long cup and handle. You can see that we have the cup here and then the handle. However, we made a double top when it attempted to break out, which is very bearish that it failed the double top of a cup and handle. We actually saw something very similar on CRM, which is a growth stock from this past year that had a just tremendous upside during 2020 and 2021. This actually had a cup and handle pattern. You can see the cup right here, and then it made the handle over here. It broke out but failed on the breakout to continue up and fell down. If a breakout fails, especially during a bullish pattern, you're going to have tremendous downside after it, and that's exactly what happened. Fell from around 320 all the way to 172, so just got hammered off of that. And that's something to note, especially looking at gold right now, that we had this double top and a big fake out from that 11-year cup and handle pattern. That's not ideal for this. Same exact thing with silver. We're seeing a lot of downside on this right now. So we're seeing a lot of the downside on commodities, which may mean there could be some deflationary pressure in the future. And in the past, deflation in the market do not mix very well. So that's another thing to note. But other than that, definitely continue to use your own personal analysis, risk reward. Again, I am not fully short at all yet. I'm going to wait for a lot more upside so I can get some good risk reward. As always, risk reward is the most optimal way to trade, in my opinion. So I'm waiting for those setups before I can go long in terms of a short level. Definitely going to wait till closer to 4,100, 4,200, whether that happens in July or August. Again, does it have to happen? No, but that's my criteria that I'm waiting for. And unless it does, I'm not going to take that long short position. I'll just trade intraday and swing around between 3 to 5 days. Other than that, though, I do appreciate you guys watching this video. Took a lot of time to make, so do subscribe if you enjoyed this content, and I will see you guys in the next video this weekend.